Welcome to the Deep Dive, where we take your stack of sources and really unpack what's most important.
hmm
Today we're diving into some key excerpts you sent over from the ConocoPhillips Form 10K Annual Report. This one's for 2024.
Right. And this isn't just, any old document. It's the company's official story for the year. It gives us that unfiltered look at their business, their financials, their strategy.
Exactly. So our mission here is to cut through maybe some of the density of a 10K and pull out the key insights. We want to understand this major energy player's core business, how they actually perform financially,
Hmm.
how they plan to return value to shareholders, and what they're signaling about the road ahead. And importantly, we're sticking only to the details provided in these excerpts.
Yeah, think of it as your targeted shortcut. We're getting straight to the heart of ConocoPhillips' 2024 directly from their own reporting.
Okay, let's get into it. Um, Maybe we should start with the foundation, their business segments, strategy, how they operate globally, because the report really paints a picture of a company with a massive international reach.
Absolutely. It's clear they manage things through, well, six distinct geographic segments. You've got Alaska, the lower 48, so continental U.S., Canada, then Europe, Middle East, and North Africa, Asia Pacific, and sort of an other international bucket.
That's pretty wide net.
It's a significant global footprint, yeah.
And within those regions, what's the core activity? What are they actually doing day to day?
Fundamentally, it's about exploring for producing, transporting, and then marketing a whole range of energy stuff. So crude oil, bitumen, and natural gas, NGLs, that's natural gas liquids, and also LNG, liquefied natural gas, all over the world.
And the report names specific countries where they were producing at the end of 24.
It does. Let's see, the U.S., Norway, Canada, Australia, Malaysia, Libya, China, Qatar, and Equatorial Guinea are all listed. So yeah, geographically diverse.
Wow, okay. And I think you flagged something about a production milestone last year.
Yeah, they did. It was actually a record for ConocoPhillips in 2024. They hit 1,987,000 barrels of oil equivalent per day globally. MBOED is the shorthand they use in the report.
Nearly 2 million barrels a day equivalent. That's substantial.
It is.
Let's maybe zoom in on a couple of those regions the report gives specifics on. How about Alaska?
Sure. In Alaska, the main production hubs are mentioned as Greater Prudhoe, Greater Kuparuk, and the Western North Slope. And the report notes a specific move. In Q4 2024, they actually bought more working interest in both the Kuparuk River Unit and the Prudhoe Bay Unit.
Okay, so strengthening their position in existing core assets there.
Seems like it, yeah. Consolidating or just upping their stake.
What about Canada? The report mentions bitumen, which sounds, well, different from standard oil drilling.
It is, yeah. It can be more complex. They have bitumen resources, specifically at a place called Surmont, and they use a technique called SAGD, that's steam-assisted gravity drainage.
Okay, how does that work?
Well, the 10K explains it's a thermal method. They inject steam deep underground, which heats up the really heavy, thick bitumen. That makes it flow more easily so they can pump it out. They've got central processing facilities there to handle all that. Plus, they also have Montney natural gas production up in Canada, too.
Got it. And jumping across the ocean to Malaysia.
Yeah, Malaysia. They're active in several fields there. Gumusut, Malakai, Kababongan, Sikap, North Pattaya are named. The report mentions they hold interests in various production sharing contracts, or PSCs. That's a pretty standard setup internationally.
Right.
Covers about 2.6 million net acres, according to the excerpt. And they also expanded there in 2024, acquiring something called the Yuba cluster.
Okay, so lots of activity. They're running existing assets, hitting records, tweaking their stakes in places like Alaska, adding assets like in Malaysia. What about the bigger strategic picture? Any major shifts mentioned?
Well, the absolute biggest one discussed, and you probably saw the headlines, is the acquisition of Marathon Oil.
Right, that was a big one.
Huge. The report confirms it closed in November 2024, valued at $16.5 billion. And it was mainly a stock deal, 0.255 ConocoPhillips shares for each Marathon share.
And the rationale given in the report for that deal?
Synergies, mostly. The report emphasizes it was on track to deliver over $1 billion in synergies, so they're expecting significant cost savings and operational efficiencies from combining the two companies.
So adding a whole company like Marathon, but are they also selling things off, trimming the edges?
Yes, exactly. The report mentions a target to sell off about $2 billion worth of assets across the portfolio. They call them dispositions. And as of the filing, they'd already inked deals to sell some non-core lower 48 assets for around $600 million. Those sales are expected to close in the first half of 2025.
Okay, so it's a mix, big acquisition, but also targeted selling.
That's the picture, yeah. Growth through M&A, but also portfolio optimization.
It sounds like 2024 was definitely a busy year, shaping the company's future footprint.
For sure. And they also highlight reaching first oil, starting up production at new sites in Norway, Alaska, and China during the year. Plus, they're expanding their global LNG business, mentioning new agreements in Europe and Asia. That's important for tapping into different energy markets.
Interesting. And the report kind of ties all this together under something called the triple mandate. Sounds like their guiding philosophy.
It really does. It's their stated commitment to three things simultaneously. First, responsibly meeting global energy demand. Second, delivering competitive returns to their shareholders. And third, working towards meeting their previously set emissions reduction targets.
Okay, that triple mandate framework is helpful. Let's drill down on that last part, the emissions targets. They talk about a climate risk strategy. What does that involve, according to this 10K?
Well, the core of it seems to be focusing production on resources that they believe have a competitive cost of supply and, importantly, a lower greenhouse gas intensity compared to alternatives. They state they're making progress towards their Scope 1 and Scope 2 emissions intensity targets. The report even mentions they set up a dedicated low-carbon technologies group back in early 2021 to look into new energy stuff.
Any specific projects mentioned there?
Well, interestingly, the report does note that in 2024, they decided to suspend their evaluation of a potential low-carbon ammonia production facility. They cited the pace of market development as the reason.
Okay, so they're working on the emissions side, but the report is also pretty upfront about the challenges and risks involved, both with that strategy and just operating generally.
Oh, absolutely. They're quite explicit. They state flat out that executing their climate risk strategy could be costly, could face unforeseen hurdles. A key point they make is about potentially needing to buy emission credits or offsets.
It's in the risks there.
They flag risks like potential supply issues for those credits, rising costs, and crucially, they acknowledge the perception risk that even if they hit their own internal targets, third parties might still see their efforts as insufficient. That's a big reputational consideration.
Yeah, that makes sense. And beyond the climate strategy itself, just the general regulatory landscape seems like a major factor.
Definitely highlighted as a risk. The report specifically calls out the EPA's final rule on methane and VOC emissions here in the U.S., and also the waste emissions charge, or WEC, which is part of the Inflation Reduction Act.
And the impact.
Both could mean additional capital spending and ongoing compliance costs. They also list a whole raft of other environmental laws they need to comply with globally, things like EPCRA, the Safe Drinking Water Act in the U.S., emissions trading schemes like the EU ETS and UK ETS, plus the tier system in Alberta, Canada. It's a complex web.
Do they put any numbers on the cost of all this compliance?
They give a couple of examples, like compliance with the EU ETS cost them about $20 million in 2024. The UK ETS was smaller, around $0.8 million. They also note that their accrued environmental costs on the balance sheet went up. Yeah, primarily for cleaning up sites, remediation activities in the US and Canada. That total accrual increased from $184 million at the end of 2023 to $206 million by the end of 2024. And they do add a note saying it's difficult to estimate these future costs precisely.
Right. It sounds like navigating regulations and potential environmental cleanups is a significant ongoing cost of doing business.
It certainly appears that way from the report. Moving on to operational risks, they also talk about their reliance on infrastructure.
Right. It's one thing to get the oil and gas out of the ground, but you need to move it.
Exactly. They lean heavily on third-party pipelines, processing plants, transportation networks. The report lists that infrastructure just not being available sometimes, maybe due to market conditions, bad weather, permit delays, or just mechanical breakdowns.
And that could impact production.
Potentially, yeah. Especially for things like that Canadian bitumen we talked about, which needs diluents mixed in to flow through pipelines. If the transport options aren't there, it could mean higher costs or even having to curtail production temporarily.
Makes sense. Another risk that affects pretty much every company now is cybersecurity. How's that addressed?
They acknowledge the growing threat landscape, risks of unauthorized access, data breaches, operational disruptions. They state they have an IT and operational technology OT security program in place. It's part of their main enterprise risk management process. They use third-party consultants for assessments, and they have processes for managing risks coming from their suppliers, too.
Have they had major issues?
They state that past threats haven't been material to their business, but they definitely recognize it's an ongoing, evolving threat.
Okay. What about financial risks, like who they do business with?
Yeah, they mentioned third-party credit risk. Basically, the risk that companies they have contracts with counterparties might default on their obligations because they run into financial trouble. That could obviously hit ConocoPhillips's results.
And the report also touches on legal issues.
Yes, a couple of things. They note a federal securities class action lawsuit related to statements made way back by Concho, a company they acquired. They say they're contesting that. They also mention ongoing disputes with some commercial partners about force majeure notices stemming from Winter Storm Uri back in 2021, also contesting those.
Okay. And one last risk mentioned was permitting delays.
Yeah, simple but potentially impactful. Just the inability to get or keep the necessary permits for construction, drilling, development activities in a timely way is listed as something that could negatively affect them.
So a pretty clear picture of the challenges operating in this complex global environment. Let's pivot now from those operational realities to the numbers. How did ConocoPhillips actually do financially in 2024, and what are the sort of guiding financial principles they emphasize?
Well, the report frames their whole financial approach around delivering, quote, superior returns through cycles. Commodity prices go up and down, but they aim for strong performance regardless.
And the pillars of that approach.
They list 4 foundational principles: maintaining balance sheet strength, providing peer-leading distributions to shareholders — that's a phrase they use repeatedly — making disciplined investments, and emphasizing ESG performance. Underlying all that, their stated value proposition is generating reliable free cash flow.
Free cash flow. Let's define that quickly. That's the cash left over after running the business and investing in it, right?
Exactly. They define it specifically as cash flow from operations minus capital expenditures and investments. And they really highlight its importance because that's the cash they use to fund those shareholder returns, dividends, and buybacks.
Okay. And beyond cash flow, reserves are always a key metric for E&P companies. What do the reports say there?
Yeah, reserves are critical for long-term sustainability. They reported a reserve replacement ratio of 244% for 2024, and the organic reserve replacement ratio was 123%.
What does that 244% mean practically?
It means they added reserves equivalent to 2.44 times the amount they produced during the year. So they significantly grew their resource base on paper, which is generally seen as positive. The 123% organic number means they replaced production just through exploration and development, even without acquisitions.
That sounds pretty strong.
It is, though the report does include the standard caution that estimating reserves involves judgment and is sensitive to things like future commodity price assumptions.
Right. Okay, let's look at some specific figures from the financial statements in the excerpts. What was the bottom line, the net income for 2024?
According to the excerpts, their net income for 2024 was $1,724 million. It's worth noting that this was down from $1,924 million in 2023 and $2,796 million in 2022. So a downward trend in net profit over those 3 years, which likely reflects commodity price movements.
Okay. And the size of the company overall? Assets, cash.
At the end of 2024, total assets stood at $123 billion. They reported having $5,607 million in cash and cash equivalents, plus another $507 million in short-term investments.
The report also gave some detail on their costs, right? Per barrel metrics.
It did. For instance, they mentioned their Canada bitumen production costs averaged around $15.19 per barrel in 2024. Looking company-wide, taxes other than income taxes averaged $3.04 per barrel of oil equivalent, or BOE.
And what about DD&A? Depreciation, depletion, and amortization.
Right, that's the non-cash charge for using up their assets. That averaged $14.54 per BOE across the company in 2024. The total DD&A charge for the year was significant, $9,599 million. These per unit costs give you a sense of their operating efficiency and asset base.
They also highlight another metric, ROCE, return on capital employed.
Yes, ROCE. They define it as net income adjusted for after-tax interest divided by the average of total equity plus debt. It's basically a measure they use to show how efficiently they're using all the capital invested in the business, both debt and equity, to generate profits.
And why do they focus on that?
They present it as a key measure for evaluating their capital efficiency and likely for comparing their performance against industry peers.
And of course, all these financial results are heavily influenced by the outside market, aren't they?
Oh, absolutely. The report explicitly lists factors like volatile commodity prices, shifts in global or regional supply and demand. Think OPEC actions, geopolitical conflicts, security issues, health crises, trade restrictions. All that stuff impacts prices and demand. They even note that prolonged low prices could force them to take non-cash impairment charges, writing down the value of their assets.
Okay, so they operate globally, manage these risks, generate free cash flow, and aim for competitive returns. A huge part of that return story, as you mentioned, is giving cash back to shareholders.
Yeah.
How did that play out in 2024 based on the report?
Yeah, this is clearly a major focus, that peer-leading distributions idea funded by the free cash flow.
What tools did they use to deliver that cash?
Well, first, they significantly increased their ordinary dividend in 2024, a 34% boost. That's a pretty hefty raise in the regular quarterly payout.
And they also had that variable return of cash thing, the VROC. How did that work last year?
Right, the VROC. They paid it out quarterly for the first 3 quarters of 2024. But interestingly, the report notes that in Q4, they basically rolled the VROC equivalent amount into the ordinary dividend payment itself.
Oh.
So the total cash returned via dividends still reflected the market conditions, but it was all labeled as ordinary dividend in that last quarter. No separate VROC payment then. However, the report does clarify that VROC is still an option the board can use in higher price environments.
Got it. And the other big lever is share buybacks. They've been doing that for a while.
A long while. The report states the current program started way back in late 2016, and a key development in 2024 happened in October. The board approved a really big increase to the total buyback authorization.
How big?
The previous authorization was $45 billion. They increased it by either $20 billion or the number of shares they issued for the marathon deal, whichever was less. This brought the potential total aggregate purchases under the program up to a maximum of $65 billion.
Well, $65 billion is a massive authorization. How much they actually spent on buybacks up to the end of 2024?
Since the program kicked off in late 2016 through December 31st, 2024, they'd repurchased a total of 433 million shares. The cost for those was $34.3 billion.
Okay, so they've already executed a large chunk of that.
Exactly. More than half of the original authorization, and now they have headroom for potentially much more. But, as the report adds, these buybacks are always at management's discretion, depend on market conditions, and can be changed or stopped.
Right.
Yeah.
So putting it all together from this 10K record production, major acquisition, planned divestitures, generating cash, returning billions via dividends and buybacks in 2024. How does ConocoPhillips seem to frame its position looking forward?
Well, they circle back to that triple mandate we talked about: meet energy demand, deliver returns, work on emissions. They emphasize doing this within what they call an evolving energy macro environment.
And that evolving environment clearly includes navigating all those risks we discussed earlier.
Precisely. The report doesn't gloss over the challenges. It recaps the significant factors they see impacting the future: ongoing price volatility, market shifts, the whole energy transition dynamic and alternative energy development, the costs and challenges of actually executing their climate risk strategy, potential bumps with infrastructure or permitting, operational risks, environmental liabilities, legal issues, and just the general uncertainty of global geopolitics and economics.
The report also includes the standard stuff about internal controls over financial reporting.
It does. Standard disclosure. Management assessed their internal controls as effective at year-end 2024. They do note, as is typical, that this initial assessment excluded the controls of the newly acquired Marathon Oil. That integration takes time.
Anything else on controls?
They also mentioned they're currently implementing an updated ERP system, enterprise resource planning. That's a major IT project for any large company. And they note it could potentially lead to changes in their internal controls down the road.
And they point out they use non-GAAP measures like free cash flow and ROCE.
Yeah, again, pretty standard. They explain they use these metrics and provide the required reconciliations back to the official GAAP numbers to give investors extra insight into performance and capital efficiency. They also steer readers towards other reports, like their sustainability report and climate-related risks report, for deeper dives on ESG topics.
Okay, so if we wrap all this up, what's the core takeaway from these 2024 10K excerpts? What does it tell us about ConocoPhillips?
Well, it tells you this is a very large, very global exploration and production company. They had a record production year in 2024. They're actively managing their portfolio, making big moves like the Marathon acquisition, presumably for scale and synergies, while also planning to sell off non-core assets.
And financially, the focus seems laser sharp on generating that reliable free cash flow and
Definitely.
then returning a significant chunk of that to shareholders, as shown by that big dividend hike and the massive share buyback authorization.
Yeah, that's a clear priority. But as the report itself lays out pretty clearly, they're navigating a really complex and frankly risky world. They're dealing with the energy transition, a growing pile of environmental regulations, and the associated costs, significant operational and geopolitical risks.
Mhm.
And they explicitly acknowledge the challenges and potential costs tied to their own climate risk strategy.
So this deep dive really gives you, the listener, a solid source-based snapshot of where ConocoPhillips stood as 2024 closed out. You see their core strengths, their financial playbook, and the major headwinds they themselves identify.
It's a picture of a major incumbent energy player trying to execute financially while adapting to, or at least navigating, some pretty powerful global crosscurrents.
And here's maybe where it gets really interesting to think about. You have that triple mandate they talk about:
Yeah.
meet demand, deliver returns, and meet emissions targets. Given everything laid out in the report, the volatile market, the regulatory pressures, the costs, what does the actual balance between those three mandates look like going forward? Especially when you consider external factors like how fast low-carbon markets actually develop or how much new rules like methane charges really bite financially. How does a company like this truly juggle those potentially competing priorities over the long haul? Something to mull over.
It's the central tension, isn't it? A very complex balancing act.
Indeed. Well, thanks for providing the source material for this deep dive.